what are we trying to do here? Okay, this is part of a balance sheet. Okay, this is statement of financial position is another name for balance sheet. Okay, and I forgot what company this is, Target or something. And so you can see from one year to another, cash balance has changed. So what the statement of cash flow is essentially going to do is reconcile this change in cash from one period to another. And we have a bunch of cash going in and a bunch of cash going out. And we're going to bifurcate that into these sections. And at the end, you'll see the exact amount of cash that changed in the period, and it will go from this beginning balance to ending balance. Okay, so you'll see that on the statement of cash flow. Okay, so it's really just explaining this because again, cash is the most important asset that a company has. It is like the blood, the lifeblood of the whole business. And so understanding exactly what cash is coming in and going out and where it went and for what reasons, you're gonna, you want that detail. Now, what does this mean? It's basically reconciling this T account. Okay, so I kind of lined this up. This is the starting balance. So this is the beginning balance, and this is the ending balance in cash. Okay, so we're only seeing this and this beginning balance and ending balance, but throughout the period you had a bunch of stuff happening to cash. So these green ones, as we're going to see, are all related. These are all operating. Okay, they relate to the sales uh, and kind of the operations of the business. This buying inventory, yes, it's an asset, but it's a current asset. It's used in the kind of day-to-day operations of the business. Collecting accounts receivable, that's related to sales. Paying accounts payable, it's all related to paying your bills. So these green ones are all going to appear somehow in the operating section of the statement of cash flow. These sold old equipment, bought equipment, this is going to be in the investing section because that's going to relate to uh, the the purchase and sale of assets that you're like long-term assets. And then you have the sale of stock. This is a financing activity. Okay, this is a way that the company is affecting cash, but through some financing transaction, right? We have again assets equals liability plus equity. So some borrowing has happened, some dividend got paid, some sale of stock happened. Something is happening on this side of the balance sheet related to the raising or extinguishing of capital, right? So if you're borrowing money or paying it off, if you're buying back stock or issuing stock, it's all going to appear in this financing section. Okay, but you can all see that cash is affected by all these different kind of components or categories. Okay, and the statement of cash flow again will reconcile this and this, but it's going to do it by splitting up these cash flows into their respective types. Okay, so the goal of the statement of cash flow is to cut through a lot of noise. Okay, there's a lot of noise with the accruals that are happening, estimates, uh, accounts receivable, accounts payable, all these non-cash related things that can be gamed, right? We saw how some games can be played with estimation of things. So what this is doing is getting to the heart of the matter. How much cash is going in and out? Okay, and by itself, it's not telling the full picture, but it can definitely help you paint a more holistic understanding of what's happening in the business. Okay, so the statement of cash flow on its own is not as useful as the statement of cash flow as part of this package of financial statements. Okay, so but it is an important one. Okay, so again, we're trying to see how much actual cash is flowing in and out of the business. For example, income statement, you can show a lot of profit, but the cash flow could be low. Okay, that could be indicative sometimes of some financial shenanigans. Okay, a lot of companies they want to again because the income statement is such a viewed and scrutinized and like valued financial statement that tells something important about the company, how profitable it is. a company may do a lot of things to make that net income look high. Um, and it may be artificial. Okay. The statement of cash flow will give you some indication if that's happening. Okay. Um, for example, if you're selling a lot on accounts receivable, um, maybe you're extending credit to customers who are never going to pay you. That's going to boost your net income, but it's not going to necessarily result in a cash flow later down the line. Okay. Um, there's a lot there, like right now with the AI stuff, uh, financing cash flows and operating cash flows are getting mixed up. There will be Microsoft or some large corporation will invest in OpenAI, for example, give them investment cash flow. OpenAI will then turn around and use that cash flow that came in as investment and create revenue for Microsoft by buying cloud services or something. Okay. And why is that important? Because when revenue appears on a company's income statement, it's going to have a big impact on its stock price, on its valuation. Okay. So a company can boost its own valuation by investing in a company and then having that company immediately turn around and buy something from that company. Okay. So it's a way to kind of take $1 of your cash on your balance sheet and turn it into $10 of valuation for your business. Okay, because every dollar of revenue gets some multiple. Okay, so this is what I'm saying. Like you got to kind of be a fan of business to learn all these tricks, and then you can see it in the financial statements. So financial accounting, knowing this language, knowing these financial statements is one part of it, but then being savvy about business. This is another thing. You guys will have to invest kind of on your own time, reading the newspaper, reading the business section, listening to podcasts, whatever it is, because then you'll learn how all those things that happen in the business world will show up on the financial statements and how you can kind of be clued into that. Okay, so um, the statement of cash flow is going to show a lot of this stuff. It also gives direct insight into how much the company is investing in its growth because it's breaking out in the investing section exactly how much the company is buying new, like kind of long-term assets for its growth versus what it's selling and kind of getting rid of. So you can see how much it's investing in its growth. Okay, so it's that investing section is also very useful. Um, the financing activity is useful because you can see what's happening on the balance sheet in terms of liabilities. That debt to equity ratio. A lot of that will be kind of revealed in this financing activity. And so there's a lot of information on the capital raising decisions of the business. And then again, the statement of cash flow will also have like between these three sections, operating, investing, and financing, it will show what changed during the period. And given that change, you can basically do beginning balance plus the change, delta. That's like a symbol for change equals ending. Okay. So the statement is really going to show all the changes in cash flow. And you just can take the beginning balance of cash. You'll see how much change between those three sections, and that will reconcile with your ending balance. And this is what appears on your balance sheet, this cash balance. Okay. Also, the matching principle is irrelevant for this statement of cash flow. It's just straight up looking at cash coming in and out. Okay. The matching principle is for the income statement because we want to match the revenues with the expenses. Okay. But cash flow is just looking at cash flow. It's not thinking about matching anything.